You know, I spent a lot of time focusing on the huge retailers that have so much clout, like Watch, that they can pretty much shrug off the impact of the trade war with China. But for the rest of the industry, things look a lot dicier. Consider the case of At Home Group. That's the home decor superstore chain, 206 locations across 39 states. For years, At Home was red hot thanks to the terrific regional and national growth story that I love. But then the tariffs hit, and unfortunately, this company's got a lot of exposure to Chinese imports. And that's why the stock has been eviscerated, falling from roughly $40 at its highs down to $4 and change at its lows last month. But in the past few weeks, At Home stock has started to come back with a vengeance. 2 days ago, the company reported again. Although the stock initially got hit on the news, it's now flying. It's up 11% today. What happened? At Home, the actual numbers were, well, they were, let's call them mixed. They earned 18 cents a share. Wall Street was only expecting 15. Sales came in a little light. You know what? I still think it was better than feared. Plus, in the conference call, management was confident that their earnings growth next year would outpace their sales growth, meaning that they believe that things can overcome the tariffs either by changing their sourcing, raising prices, strong-arming suppliers, you know, all the stuff that everybody has to do in retail now. So can the stock keep rebounding, even though it's caught in the crossfire of the trade war? Let's check in with Lee Bird. He's the chairman and CEO of At Home Group. Find out more about the quarter and where the company's headed. Mr. Bird, welcome back to Mad Money.
Great. Hey, thanks.
Good to see you, Lee. Good to see you. Okay, so Lee, it's kind of like it was like a little bit of an Annabelle's horriblest perfect storm. I mean, you got the tariffs. You got a slowdown in some parts of home. And now I wonder whether the stock was too high and now it's too low. I mean, you have to believe that this pendulum's swinging too far.
Well, we feel like we're undervalued. We're a high-growth retailer. We grew 19% last quarter.
Right.
We continue to gain share. We're profitable, and we've got a whole lot of white space in front of us.
But at the same time, you did the unthinkable for the growth guys. You said, you know what, we got to go a little slower. And yeah, the growth guys just want, they want you to go 300 to 500 to 1,000 stores. You pulled back and said, listen, we're going to try to figure out what's the best. And you went to EDLP, you went to everyday low pricing, which is what I love, because EDLP wins over the consumer. How is that change going?
So we've always been EDLP, but now we're calling about EDLP Plus. It's really more of an approach to market. It's a go-to-market strategy. We've always had low prices, but with all the noise and the promotions and the sales out there, we've just not been getting credit for it. So we're modifying our approach by having category-by-category events every 2 weeks to highlight the great prices and then change the inside of our stores dynamically over the next few months so that our customer will see that and will continue to enhance the treasure.
Okay, so that's the surgical price increases that you're talking about. Because those confuse me. I mean, I'm trying to figure out whether you're trying to beat Wayfair and Amazon, whether you're going against other, the home business that some of these department stores have. Because I'm concerned when I see a stock go down like this, and I know you're going profitable, but you don't have that much cash, I get worried that I'm missing something, that you're regional, national, good company, well-managed, but the punishment the stock endured tells me that maybe there's something else I'm missing, the tariffs that bad for you?
I think there's been a lot of cloud in the story, but I would say that we feel like the market doesn't quite understand and sees us, well, let's just say we're undervalued. Okay, because we keep growing, we're profitable, we have a great market potential. We're at 200 stores to go to 600 stores, and we're the low price leader. And we feel like we're perfectly suited to win in the marketplace and have been winning. We've been growing 20% a year for the past 5 years.
I know, but you had 2 quarters of down comps.
We did. We had 2 quarters of slightly negative comps. But the weather was super tough.
I know, but when you have 18% revenue gain and 2 down comps, that is a WT Grant formula. That's what we learned at Goldman. It's a WT Grant. You can't have that big sales increase and have the comps go down. Can that change?
It can change. That's why we're focusing on this EDLP Plus approach. We feel like this is within our control. We can do better. We feel like we're not getting enough credit for our prices. That's why our go-to-market strategy is being adjusted. But we always have win on low prices.
But how are you going to be able to, let's say the trade war, he takes tariffs, the president takes tariffs to 30%, which is what I understand he wants to do if these talks fail. What is your plan? And it can't be to Vietnam, because the president's about to hit Vietnam pretty hard.
We've had a playbook. We've been working on this for a year now. We've had a lot of experience, obviously, with it. We've worked with our suppliers to both mitigate and migrate out of those countries. We've gone direct sourcing. That's another area where we take the middleman out. We also look at how to diversify in other countries. And lastly, we do take surgical price increases only after our competitors have already taken price.
I would think that with the stock plummeting this far, that you would be a buyer yourself.
We think the stock is undervalued. It's an opportunity.
Are you a buyer yourself?
I've been buying at different times throughout the past 3 years, and I still think it's a great opportunity.
All right. Now, you've got what I consider to be a fabulous category, but the category somehow has cooled a bit. Why is that with unemployment at 3.7%? The category.
I think the category has been choppy for the first half.
Yes, it has, but why?
At negative 3%, 5% traffic overall.
But shouldn't this be a great category if everyone can get a job?
I think it's a great category for us. We're the low price leader, and people are very cautious of how they spend their money. I think consumer spending is healthy, but the consumer is very savvy around price. And we're the low price leader. We're perfectly suited to continue.
Do you come under Wayfair?
We do.
You do?
We come under all the, we try to win on price. We're below everybody else's sales price.
Well, it is just a quandary. I mean, I'm sure you're as mystified as I am. I mean, I think that it was a super growth stock, and then you decided to put the brakes on prudently. And I thought that the prudent thing was a great thing. But these guys, well, and maybe that's the rally. Maybe people are recognizing that a prudent high growth story is better than a super high growth story that is unsure of itself.
We think it's the right approach going forward. We think a balanced approach of growth and profitability, as well as a focus on free cash flow and reducing our leverage, is the right balance for us going forward.
Well, I agree with you on that, and I wish you the best of luck.
Thanks.
Quite frankly, mystified that they would hammer it this low. The 11% gain seems right to me. That's Lee Bird, Chairman, President, and CEO of At Home. Guys, just because someone slows down their store growth doesn't mean the story's over. It may be just the opposite.